Imagine pouring your hard-earned money into a stock, dreaming of steady, reliable incomes from dividends, only to watch that safe investment crash, taking your principal right along with it. What if the very thing that attracted you to that juicy dividend yield was actually a hidden danger, financial illusion? Today, we're diving deep into two major pitfalls that can completely derail your dividend investing journey: dividend traps and the pervasive dividend fallacy. And if you're new to our channel, hi, I'm Stephanie. Welcome to Permission to Be Wealthy, where me and my husband Joseph have open and honest conversations about what it's like to build wealth, invest, and pursue financial independence with balance. We've been living abroad for 7 years now, and the last 3, we've been navigating life as a financially free family of 4 right here in beautiful Portugal. We're here because we believe everyone deserves the clarity and confidence to build lasting wealth, and today that means shining a light on some critical misunderstandings. We're going to break down exactly what the dividend trap is, expose the dividend fallacy, and then most importantly, I'm going to show you how to spot red flags so that you can protect your portfolio. We're going to look at some real-world examples, both good and bad. And if you stay with me until the very end, I'm going to share with you powerful, real-life, data-driven approaches that reveal exactly the cost of chasing those high yields. Comparing individual stocks with more diversified strategies, it's a revelation that you don't want to miss, so be sure to stick around for that. So first, let's talk about the infamous dividend trap. What exactly is it? Think of it like this. It's a stock with super high dividend yield, often looking incredibly attractive on the surface, but that high yield is actually flashing a red light. It signals that a company is in deep financial distress, and there's a very high likelihood that the dividend payment is about to be cut or even suspended entirely. Now let's tackle an even deeper misconception. It's what we call the dividend fallacy. This is key. Many people believe that dividends are extra income, like a bonus on top of the stock's capital gains. But here is the truth. When a company pays a dividend, that money is distributed out of the company's real value. In most cases, the stock price is adjusted downward, the amount of the dividend paid. So it's not extra income, it's a portion of your overall total return being paid out, not an addition overall. So let's break down these two concepts into a specific illustrated scenario. Imagine a company where the stock price is a combination of its future earnings potential and the dividend that it pays out. So here we have future earnings, share price, and annual dividend. In year 1, our company has future earnings of $100, pays an annual dividend of $5, and its share price reflects that $105. Its dividend yield is a healthy 4.76%, and the dividend payout ratio, which is the percentage of earnings paid out on its dividends, is 50%. It seems perfectly balanced. Now watch what happens in years 6, 7, and 8. Notice how future earnings are declining rapidly from $100 down to $70, then $50, and then $40. This is the company's business struggling. But for a while, the company tries to maintain its annual dividends at $6 to keep investors happy. So what happens to the share price as earnings fall? It drops significantly from 106 down to 76, then to 56, then to 46, because the dividend amount is staying flat while the share price is plummeting, and the dividend yield looks like it's absolutely exploding. Well, we go from 5.66% in year 5 to 7.89% in year 6 to 10.71% in year 7, and then a massive 13.04% in year 8. This is the dividend trap in real action. That incredibly high yield is a siren song pulling investors in, but it's fueled by a falling stock price, not necessarily rising profits. And the dividend payout ratio tells a real story. It jumps from 50% to 80%, then 85 and 90%. This shows that the company is paying out almost all of its shrinking profits just to keep the dividend alive. And this is clearly not sustainable. They have almost no money left to reinvest in the business or handle any unexpected challenges. And then, as you can see in year 9, the inevitable happens. The annual dividend is slashed from $6 down to $2. This is the moment that the trap springs. The dividend yield is crashing back down, and investors who bought simply for that high yield are left holding a significantly devalued stock with a much smaller payout. This is why chasing a high yield is so dangerous. It's like focusing only on the bait and not seeing the snare. An incredibly high dividend yield, especially one that surged due to declining stock price, is almost always a warning sign and not an opportunity. Now, let's look at some real-world companies that have fallen into this trap or demonstrated the fallacy, highlighting that these aren't just theoretical concepts. These are stories where investors lost significant value chasing a seemingly attractive yield. First up, we have AT&T, or T. For years, this telecom giant was known for its high dividend yield, often hovering at the 6 to 7% range. It felt like a stable income generating machine. However, AT&T carried a massive debt load from past acquisitions, and the telecom industry is notorious for being very competitive and capital intensive. All that debt and the need for constant investment put immense pressure on its cash flow. The skepticism from analysts grew, and sure enough, a major red flag was waved when AT&T significantly cut its dividend in 2021, largely due to the Warner Media spinoff. Investors who had held the stock primarily for its high yield suddenly saw both their income cut and their capital erode, a harsh lesson of the dividend fallacy. Next, let's consider Walgreens Boots Alliance, WBA. In late 2024 and early 2025, WBA's dividend yield soared to an eye-popping 8 to 9% as its stock price plummeted. It had been a long-time dividend grower, even a former dividend aristocrat, which made that high yield even more tempting. But its core retail pharmacy business was facing immense pressure from online competition and lower reimbursement rates. Concerns about weakening financials and a declining free cash flow also intensified. Tragically for income investors, Walgreens officially cut its dividend in January 2024, ending a multi-decade streak. This is a classic dividend trap playing out in real time. The high yield was just a symptom of a struggling business, not a sign of strength. And those aren't isolated instances. They serve as a powerful reminder that a high dividend yield, especially when accompanied by a falling stock price, is a serious warning sign. It almost means that the market is pricing in significant risk or anticipating a cut. So how do we avoid these costly mistakes? It's about learning to recognize the warning signs, the financial red flags that tell you that a dividend might not be sustainable. Think of these as your essential tools for protecting your portfolio. So first, unsustainably high yield. If a company's dividend yield is significantly higher than its historical average or wildly out of line with its industry peers, that should make your ears really perk up. It often means that the stock price has fallen, making the yield look good on paper, but the market knows that something is wrong. Second, declining earnings or revenue. A company needs to make money to pay those dividends. If its sales and profits are consistently shrinking over time, several quarters or years, it's a huge red flag. They simply won't have the cash flow to sustain those payouts. And third, and this is critical, a high payout ratio. This ratio tells you what percentage of a company's overall earnings or free cash flow is being paid out in a dividend. If a company is paying out nearly all of its profits, let's say over 70 to 80% in most industries, there is very little room for error. One bad quarter, one economic downturn, and that dividend is in serious jeopardy. Then fourth, increasing debt. Companies that take on too much debt to fund their operations or worse, to pay the dividend, are playing a dangerous game. High debt levels can make a company very fragile, especially when interest rates rise or revenues dip. Be sure to look for rising total debt on their balance sheet over time. And finally, industry-specific challenges. Is this entire sector facing headwinds? Think about disruptions to traditional retail or the challenges in certain energy sectors at various times. These broader industry shifts can put immense pressure on a company's ability to maintain its dividend. By diligently checking for these red flags, you're not just reacting to bad news, you're proactively building a robust portfolio. And if you're finding this information helpful in protecting your investments and building a smarter portfolio, please hit that like button and subscribe to our channel for more insights on building wealth with balance. So if chasing a high yield is dangerous, what is the path to building a truly sustainable dividend income stream? The answer is kind of simple. Focus on quality, not just yield. A lower but consistent growing dividend from a financially sound, well-run company is far more valuable than a sky-high, unsustainable one. So here's what I want you to look for in truly healthy, sustainable dividend stocks. First, constant dividend growth. Look for companies with a long track record of increasing their dividends year after year. These are often called dividend aristocrats or dividend king companies. They have proven their ability to grow payouts with various economic cycles over time. Second, a strong balance sheet. This means low debt, plenty of cash reserves, and a history of financial prudence. Next up is healthy free cash flow. This is the actual cash that a company generates after paying for all of its operations and capital expenditures. This is real fuel for dividends. If they have abundant free cash flow, then they can comfortably cover their dividends. And lastly, a reasonable payout ratio. As we discussed, you want that dividend payout to be in a sustainable percentage of their earnings or free cash flow, generally between 30% to 60% range, depending on the industry. So now let's look at a couple of popular solid examples that embody these indicators. Johnson & Johnson, J&J. This healthcare giant is a classic example with a wide economic moat, meaning that strong competitive advantages, a multi-decade history of consistent dividend increases. J&J is often considered a gold standard for reliable dividend growth. They have diversified their business across pharmaceuticals, medical devices, and consumer health, which helps to stabilize their earnings. Then there's PepsiCo, PEP, a powerhouse in consumer staples. PepsiCo owns the beloved brands of Pepsi, Lay's, and Quaker Oats. Their constant demand, strong global presence, and robust cash flow often have allowed them to maintain a remarkable track record of dividend growth for decades. Now, an alternative approach to building a diversified dividend portfolio is gaining popularity, and especially in today's market, it's through ETFs or exchange-traded funds. These funds hold a basket of stocks, automatically giving you diversification and professional management. You don't have to rely on picking individual companies as much. ETFs like VYM, Vanguard's High Dividend Yield ETF, and SCHD, Schwab's U.S. Dividend Equity ETF, are fantastic examples that focus on high-quality dividend-paying companies, but we also have newer, more innovative options like DIVO, Amplify CWP Enhanced Dividend Income ETF, SPYI, NEOS's S&P 500 High Income ETF, and JEPQ, JP Morgan's NASDAQ Equity Premium ETF. These funds often combine dividends with premium income generated from strategies like covered calls on diversified indexes. And while you always have to keep taxes in mind, depending on your income-oriented journey or where you have these investments, the beauty of these modern ETFs is that you don't have to rely on picking specific companies to build a robust income approach in your portfolio. They bring diversification and often a smoother ride. All right, it's time for that real life data-driven insight that I promised you. This is where we truly see the difference between chasing a high, risky yield and building a diversified, sustainable income portfolio. We're going to compare how individual dividend-paying companies might stack up against some of these more diverse dividend or premium-paying ETFs, but through the lens of total return, not just dividend dollars and not just yield, because remember, losing your principal can wipe out years of dividend income. So let's imagine that we've invested a hypothetical $100,000 across different time periods, 10 years, 5 years, 3 years, and 1 year. We're looking at total return, which includes both dividends received and any capital appreciation of the shares themselves. I'm going to highlight the income winner who paid the most dividends. Then I'm going to highlight the NAV winner whose underlying net asset value grew the most, and the overall winner for total return. First, for our 10-year observation for that $100,000 investment, our income winner was PepsiCo at $29,865. The NAV winner, meaning that the fund or stock where the underlying principal grew the most, was SCHD at $295K. And the overall winner for return was also SCHD at $319,000. Now let's look at the 5-year observation. This is where some of the newer funds start to launch, like DIVO. Here our income winner was DIVO with $20,000. Then the NAV winner was VYM at a little over $200,000. And the overall winner for the total was DIVO, $214K. So moving to the 3-year observation, this is where SPYI and JEPQ really come into play. The income winner was SPYI with 33,000. The NAV winner was JEPQ at 166, and the overall winner for the total return was JEPQ at 196K. And finally, in our 1-year observation, the income winner again was SPYI with 12K. The NAV winner was VYM, which outperformed strongly during the market recovery coming out of 2024 at 117K. And the overall winner was SPYI at $125,630. Now, I want to empower you even further. I use stockanalysis.com for all of my stock research. I highly recommend it. You can find that linked in the description below. What this data powerfully illustrates is while individual companies like PepsiCo can be great for income over the long term, diversified ETFs often provide a more balanced approach, giving you both income and significant capital appreciation. And crucially, it highlights how diversifying your approach can potentially protect you from catastrophic losses associated with individual dividend traps. The goal here isn't just high yield, it's high total return over time. So to recap, we've talked about the alluring yet deceptive world of dividend traps, exposing how high yield can be a red flag, not a green light. And we've debunked the dividend fallacy, clarifying that dividends are a distribution of value, not extra money. By understanding these common mistakes and focusing on quality, not just yield, you're not just avoiding pitfalls, you're actively building a more resilient, a more robust, and ultimately a more prosperous financial future for yourself. You are giving yourself permission to be wealthy, armed with knowledge and smart strategies. And remember, the exact spreadsheet from today's discussion with all that powerful data comparison will be available for you to download for 1 week. Just check the description down below. If you found today's deep dive valuable, please be sure to like this video, subscribe to our channel for more honest conversations about building wealth and pursuing financial independence. And as always, I hope today's video gave you a little bit more food for thought on how to give yourself permission to be wealthy.